Not knowing how to tell the difference between a bull market, a bear market, and a sideways market is one of the main reasons traders keep losing money. Before you place any trade, you need to know the direction of the market. Are we going up? Are we going down? Or are we stuck in a range? So hit the like button, subscribe, and turn on the notification bell so you never miss a video that could save your capital. Let's start with the most exciting one, the bull market. What is a bull market? In simple words, a bull market means prices are going up. Think of it like a market is climbing a hill. In this phase, people feel positive and excited. Investor confidence is high, and most people expect price to keep going up. So there is lot more buying than selling. In technical terms, a bull market is when major stock indexes like NIFTY, S&P 100, FADGI and DFMGI index have gone up by 20% or more from recent lows. So what do you do in bull market? You mostly look at the long trades. That means you buy and aim to sell at higher price. Short trades betting the price will fall are risky in bull market because any price dip are usually just temporary pullbacks. It's like swimming with the river current. If you trade with the current, it helps you carry forward. Even if your entry isn't perfect, you still have a good chance of profit. How to identify a bull market using price action? The first way is higher highs and higher lows. If each new high is higher than the last and each new low is higher than the last, you are in a clean uptrend. This pattern means buyers are in control. In this case, look to buy during pullbacks, especially near support levels. The second way is consolidation, followed by a breakout upward. Price moves sideways for a while. This is consolidation. Then it breaks out above the pattern. That means buyers are back in charge and uptrend is continuing. A breakout like this often a great entry point. Third way is bullish engulfing candles. This is a big green candle that completely covers the red candle before it. It shows strong buyer momentum and is reliable signal that bull market is alive and well. The fourth way is upward trend line under price. If you connect the swings low and draw a rising trend line, it confirms the market is moving up. Price often bounce off this line and it's a great area to find a long trades. The fifth way is price staying above 50 EMA. EMA stands for exponential moving average. When price stays above it and doesn't cut through it often, the trend is strong. Pullbacks to the EMA are often excellent places to look for long entries. How to know when the bull market is ending? Trends don't last forever. Let's talk about signs that bull run is slowing down. The first sign, a lower high forms. Instead of a new high, price moves up and then turns down, but doesn't reach the previous peak. This is a warning signal. Second sign, a lower low forms. Now price breaks below the last swing low. This confirms the uptrend has lost momentum and sellers are stepping in. Third, consolidation followed by a breakdown. Price goes sideways, but instead of breaking higher, it breaks lower, below the range. This is often the start of trend reversal. Fourth, bearish engulfing candle form. This is a big red candle that's bigger than green candle before it. It shows heavy selling pressure, possibly from profit taking or fear. Fifth, a gap down. If the market opens way lower than where it closed previously, it could mean panic or bad news. Sixth, a break below the trend line. If price drops under the rising trend line, uptrend may be finished. Seventh, a break below 50 EMA. When price crosses below this moving average and stays there, it usually means the bull market is over. What is bear market? A bear market is when prices are falling. Imagine the market going downhill. People feel negative or scared. Investor mood is negative. People expect price to drop. So there is more selling than buying. If the market falls 20% or more from recent highs, it's officially a bear market. In this case, you want to look for short trades. Sell high, buy lower. Trying to buy in downtrend is risky unless you are seeing a real reversal. Now, how to identify a bear market? First, lower highs and lower lows. Price makes a new low, then bounces up, but not as high as before, then drops to a new low again. This shows the trend is clearly down. Look to short during pullbacks to resistance. Second, consolidation followed by breakdown. Price moves sideways for a bit, then breaks down below the range. That shows sellers are still in control. Third, bearish engulfing candles. These are large red candles that took over green ones before them. This shows strong selling and fear in the market. Fourth, a downward sloping trend line above price. If price keep respecting a falling line connecting swing highs, the market is bearish. Short trades works well near this line. Fifth, price stays below 50 EMA. If price is under moving average and pullbacks to it before falling again, it confirms the downtrend. How to know when the bear market is ending? First, a higher low forms. Price drops but doesn't go as low as before. This shows that buyers are starting to step in. Second, a higher high forms. Price break above the previous swing high. This is a powerful reversal signal. Third, consolidation followed by a breakout up. After moving sideways, price goes above the pattern. That's a clear sign that the sellers are losing control. Fourth, bullish engulfing candle. A big green candle takes over the red candle. This means buyers are gaining power. Fifth, a gap up. Price opens up much higher than where it closed earlier, often due to good news or strong demand. Sixth, a break above trend line. If the price crosses the downward trend line, the structure is changing. Seventh, a break above 50 EMA. Price getting above this moving average often means the bear market is ending and a new uptrend may begin. What's neutral or sideways market? Sometimes price doesn't go up or down, it just moves sideways in a range. This is called neutral or sideways market. Here is how to know. Price keep bouncing between the same high and low zones. Moving average is flat, cuts through the price. You can draw a clear support and resistance zone. In this market, you can trade both long and short, but only at the edges of the range and only with the confirmation. To wrap up, watch the structure. Higher highs and higher lows equals to bullish, lower highs and lower lows equals to bearish, flat highs and flat lows equals to neutral, break of trend line or key support resistance equals to reversal, engulfing candles, moving average flips is equals to momentum shift. Use these signs together, not just one alone, to confirm the trend direction or change. If you want to trade like a professional, first learn to read the market condition. Is it bull, bear, or sideways? And is that condition about to change? Once you master this, everything else becomes easier. Let us know in the comments what topics you would like us to cover next. Hit the like button, subscribe, and don't forget to share. Thanks for watching. I will see you in the next episode. Happy investing.